What's up, everyone? It's Scotty with Money Vesting. So wanted to talk a little bit about inflation numbers that came out earlier today at 8:30 a.m. Eastern. We were live to cover those numbers, so you can definitely check out our long live stream breaking down the CPI numbers and of course the market's reaction live to what the CPI numbers were. So in this video, my goal is to break down those numbers in a little bit more detail, give you some context. Intraday, the markets are really selling off. NASDAQ has pretty much given back all of the gains. S&P is also coming in close to being flat on the day. The Dow is the only index that is maybe remotely higher, up over 56 points, but both of the other indices are very, very flat. So hope you guys enjoy this video, find it helpful. If you do, make sure that you drop a like. Don't forget to subscribe to the channel if you're just joining us for the first time. The link to our Discord and Patreon is going to be down below if you're interested in joining, and of course getting access to all the buy and sell alerts, options alerts, trade ideas. Everything's going to be included, as well as the intrinsic value spreadsheets and of course members only videos and trade ideas that I will be posting for members later this weekend. And of course there's a couple more trade ideas that I want to go over. So this right here is going to be the CPI numbers. Before we do that, just want to give you a quick update. Markets have pretty much given back on all the gains. Like I said, S&P 500 has been selling off consistently over the last 3 to 4 hours, and it is down over 1.26% intra-day. That is, again, a pretty substantial drop here. Same thing with the NASDAQ. It did rally higher for the first 30 minutes, and since then, it's just been selling off down 1.5% intraday. And of course, the Dow Jones here also dropping over 300 points. In fact, dropping over 400 points, down over 1% intraday. So definitely seeing a lot of selling pressure, and not to mention the yields moving in the opposite direction, pushing higher from lows of 3.95% to now back over 4%, pushing up over 2.2% intraday. So this right here were the numbers. CPI month over month came in line with expectations, 0.2%. Year over year ticked higher to 3.2% from 3% same time last month. And of course, ex-food and energy, which is your core CPI, increasing 0.2% in line with expectations, and year over year taking down from 4.8 to 4.7%. So on the surface level, you can kind of see we pretty much got a better than expected number, right? So this was in line with expectations. So I'm basically going to say either miss, hit, or met. So this right here, met, hit, and hit. There was no misses across the board. We either met expectations or we hit expectations out of the park, meaning it was better than what the consensus was. However, that being said, expectations are only subjective. They're only relative, right? That's what I mentioned before, is that it's useless. It's really just useless to try to basically compare these numbers to expectations, because they don't tell us anything. It's all about perception, right? The reality of the situation is that headline moved higher from 3 to 3.2%. Core did come down, but not fast enough. So 4.8 to 4.7, which is still an improvement, no doubt. I mean, this number was well over 8 to 9% in June of last year. So it's still a dramatic improvement. But of course, we're seeing that disinflation happen at a very, very slow rate. And again, 4.8 to 4.7% is where we're at. Again, it doesn't matter whether we beat expectations or not. On an absolute basis, we are slightly lower. So the market is now pretty much pegged for no hikes in September. So over a 90% probability that the Federal Reserve is not going to do anything. Only 9.5% probability that the Federal Reserve is going to raise rates by 25 basis points. But the real fun begins in November, when there is still a pretty decent split with 75% of the market pricing in no changes, so no hikes, and then 24% of the market pricing in for another 25 basis points, bringing that target range to 5.5 to 5.75 percentage points for the federal funds rate. Now, this right here, something that Charlie Buell also posted on Twitter, so shout out to him. So US CPI has moved down from a peak of 9.1% in June 22 to 3.2% today. And of course, what's driving lower inflation or this decline is lower rates of inflation in fuel oil, gasoline, gas utilities. So those three things are now no longer going to be the case, because inflation is very much dependent on energy prices. And as we know, crude oil has been going higher. So crude oil, in fact, was up close to 3%. Fuel oil was up 3% month over month, which obviously is a pretty big deal. Used car prices definitely have been on significant decline. Medical care, electricity, apparel, new cars, food at home, and food away from home. So basically food and agriculture products have also been selling off. But I think that is very close to a potential reversal back higher, considering that energy cost is going higher. So that's going to translate over to food as well. And of course, who has to bear all these expenses is the end consumer. Now, shelter and transportation are the only major components that have a higher inflation rate than June 2022. So again, you can pretty much come over here. Shelter 2023, it's at 7.7%. Transportation is at 9%. So those right there are the two industries, or two really the sectors or components within CPI that are higher than same time last year. But food away from home, even though they mentioned that it's declining, not really, right? 7.1% is where we're at. Yes, it's down from same time last year, but it's still pretty high. Food at home is down 3.6%. And of course, all the other metrics are also in significant deflation, especially when you look at medical care, used car, gas utilities, gasoline, and fuel oil. But these three right here are also a bit of a wild card because, as I mentioned earlier, come over to crude oil, it is up to over $83 a barrel. So this right here has been a straight up rally. Gas prices are up over 8.5%, closer to 10% for per gallon basis in the US. And that obviously is going to start showing up very soon in the CPI prints as well. So bottom line is this right here is Will Compernol. Man, they've got some really strange last names. But from FHA Financial lists 3 reasons why his firm is cautious about reading the July CPI and the end of worrisome inflation. He says the 4.7% year-on-year core CPI rate, which strips out food and energy prices to provide a purer read on inflation, is still more than twice the Fed's 2% target, of course. And rising energy prices that begin in late July, which again we've been talking about for quite some time, should push up the headline inflation rate starting with the data released next month and pose an upside inflation risk to the core index from pass-through to energy-intensive industries like manufacturing and transportation services and even food. And the annual rate of core inflation based on another reading, known as personal consumption expenditure, so PCE, is also far above the Fed's 2% target on the most recent reading released in late July. And the Fed targets PCE and not CPI inflation. A methodological difference between the two have proven to be important this year, especially like for components like airfares and medical care services. So exactly the things that I mentioned, right? The Federal Reserve's target is 2%. We're way higher than that. And energy obviously posing a bit of an upside surprise for inflation moving forward. So I think that's one of the reasons why the markets are selling off on an intraday basis, and we're very flat, because this week, last week have all been red for the market. So it's not surprising that there is a level of seasonality that's kind of playing into the narrative, because August and September obviously are the red months, or the more brutal months for the market. And when it comes to inflation, we were on our way down. We are still on our way down. We're seeing some disinflation. But the fact of the matter is that oil prices are once again on their way up. And not to mention, shelter is still taking its sweet time in coming down. So it's possible that we may not be done with the interest rate hikes if, of course, the August print that comes out in September, if that plus September print that comes out in October, is if those two prints continue to suggest that inflation is going to be sticky, if it's going to stay up there for a while, because, again, core is at 4.7, headlines at 3.2, 3.3. So we're way above the Fed's target. If it's going to stay there for a little bit longer, it's possible the Federal Reserve does not back down, raises rates by another 25 basis points. That's going to be a bit of a surprise for the market. But I think 25 basis points marginally isn't going to do much to hurt the economy or the market. I mean, most of the damage has already been done, which, of course, with the time lag is still yet to be seen. So my game plan in this market environment is, again, look for deals, look for opportunities. In the meantime, trade options and continue to do that experiment of dollar cost averaging into a little bit more diversified Vanguard index funds. But when it comes to individual stocks, I'm being very selective, very picky. I'm not going out there gobbling up shares left and right, because I know the valuations are a little bit too high and there are no deals to be found just yet. So I hope you guys enjoyed this video, found it helpful. Make sure that you drop a like. Don't forget to subscribe to the channel. Link to our Discord, Patreon is going to be down below. Let me know your thoughts down in the comment section below. What did you make of inflation overall? It's always happy investing. I'll see you all in the next video.